Well, good evening and welcome to this live stream event on the 20th of August 2019. Martin North from DFA here. This is the pre-show bit, so I'll just let this run for a couple of minutes, see who else joins. We've already got 289 concurrent viewers on, so that's pretty amazing. And welcome to you all. I must admit, I'm getting to the point now where if I start reading off all the names down the list, I'm going to be here all night. So I probably won't do too much of that tonight. But just to say, we've got people from Canberra, we've got people from New Zealand, from Mackay, from all over the place. It's really good to see you all. And, I really appreciate your taking the time to spend time with me tonight. It's a really blowy, blustery, cold winter evening here in Sydney. But I think we're going to have a pretty warm discussion tonight. So I'm just going to let this run for a little bit longer. And good to see some old names and some new names on the stream tonight. Tremendous to see the support we've had. And I want to just remind you, please, to do share and like our posts. It's really important that we get the word out. The sort of stuff that we're covering is very important to us all. And hopefully now you've been following us for long enough to understand that quite often we are ahead of the curve when it comes to some of the critical issues, be it the cash ban or poor quality construction or poor lending or whatever it may be. Yes, Skynet's asking whether we can do value of property in terms of gold. I'll have a look at that. I know one or two people have been asking for that recently, and there's a few other things. Cairns, that's Janelle. Really good. Not cold here. No, it's cold and wet in Auckland. And I suspect Melbourne may be a bit chilly tonight as well. So that's just the way. Hi, Genevieve. Genevieve, it's good to see you. Blobfish King, Brett Hunter, Andre, Jasmina from Abu Dhabi. Well, that's very good. Okay, so I'm just going to run this for just a little bit longer and then we'll go to the formal show. As with all of these things, the question always is, will everything work as we plan? Hopefully it will. I hope you liked my new countdown system, which saved me coming on and having to give the countdown myself. So, all right, yes. Somebody's saying there's a real bargain to be had at Mascot Towers. Define bargain, I think is what I'd say for that. Yeah, interesting question about merch. We haven't really got that. There's been a bit of talk about it, but, I've been rather busy. And I'll talk a bit about some of the other stuff that's been going on in the background as we proceed. All right, so I reckon we've been running for long enough. So I am going to run the intro and then we'll get going formally. So stand by. Here we come. Well, good evening and welcome to this live stream event on the 20th of August 2019. Pleased to have you on board, and it's good to have so many people joining us tonight. It's Martin North here. I'm the Principal of Digital Finance Analytics. It's great to have you on board with us, and we're going to have some interesting discussions tonight. So, as normal, what I'll do is I will go through just some initial conversations and slides to set the agenda. During that time, I won't really be following the chat particularly closely. So if you've got burning questions you want to ask me, hold off until I tell you that I'm going to be looking back at the chat. I believe Joe Wilkes will be around and helping to moderate, and that just gives us a little bit of safety and security with regard to what's going on there. And just to say, we've got more than 400 people on the show at the moment, which is pretty amazing. So let's go to the running order firstly. And so on tonight's show, we're going to start, a bit like we always do with just this introduction, which we've now done. House rules, just really to say, let's be aware of just courtesy and all those sorts of things. I'll talk a bit about our models, just because there will be new people on the stream and who may not understand how we do what we do. I want to touch on a few key slides, really just to help set the agenda and also to share some of the latest and greatest information we've got. Then some questions and answers. Now, I've had more than 350 questions sent to me in the last couple of weeks. So I can tell you I can't answer them all individually. But what I have done is to cluster them into themes and topics. And what I'm hoping is we might get some of those questions on the line tonight, and that will allow me to basically answer that question and also, answer those around it. If I don't get the question, then perhaps towards the end I'll switch to the topic in any case. So that's my plan. And then we'll sign off. This normally takes about an hour and a half, maybe slightly longer, maybe slightly shorter. Depends a little bit on how we go. And that's pretty much it, really. So buckle in. Just in terms of house rules, please, I have to say, I always do, this is not financial advice. I'm not qualified to give financial advice. I'm not allowed to give financial advice. I don't know your individual circumstances. I always say, if you need specific advice, then get that from a qualified, carefully selected, validated financial advisor. What I can do is to talk in general terms about my research and what I'm seeing in and around the place. And if it helps to perhaps set an agenda or set some themes running that you want to pursue, then that's what I am really here for. So this is about basic education, information sharing, and trying to help people navigate the complexities of financial services, but this is not financial advice. Please play nice in the chat room, no racial slurs. We've had a few people we've had to ban over the months. We don't like doing that. There is an amazing community around DFA and IOTP, and we value all members of the community with their different views and opinions. And please respect each other and respect the conversations that are going on here. And specifically, I just want to thank you, so many of you, for sending messages of support with regard to my wife. As you may know, was in hospital for 5 weeks. She's still very weak, but she's now home, I'm pleased to say, and that's really great news because it's never nice being in hospital. She's got a long way to go, but I'm pleased to say she's home now. And as I say, really appreciate all those messages, comments, prayers, all those things. Every one of them was gratefully received, and it just demonstrates to me the power of the community we've got here. So thank you for that. Now, this is as at the 20th of August 2019, so if you're watching this in replay, you'll know later whether I was right, whether I was wrong, whether everything I said was completely the wrong way around, but nevertheless, it's as at concurrent today. Please do use @WalkTheWorld if you want to get my attention in the chat. There are many, many conversations going on. There are very good cross-quant conversations as well as people asking me questions, but if you want to ask me a question, then please do use @WalkTheWorld. That will help to make sure that I don't miss it. I have enabled Super Chat, and there's a couple of features around that. Firstly, if you want your question to go to the top of the list and really be featured, that's something you can do via Super Chat. It also enables you to make donations to us on the fly, as it were, and we really do appreciate those who are supporting us. We do have ongoing expenses relating to running DFA and IOTP, and every dollar that's donated is actually ploughed back into making more content. So there's no profit in this for any of us here. This is all about just covering the costs of what we do. So Super Chat is something that is there. You're not required to use it, but if you'd like to use it, it is enabled. Now, just quickly on our core models, as you may know, we run our household surveys, 52,000 households at any one time, 4,500 or thereabout a month. We ask them about their finances, their attitudes, so qualitative and quantitative. We also do the same for the SME sector. And we also plug in a whole bunch of other information from RBA and from other public sources, and also the reports from the various banks and other institutions. That goes into our core market model. That core market model then drives all our analysis, our reports, and it also drives the posts that we make on DFA blog and on YouTube and on everything else. So that's the way it plays out. And we've been running these models since the early 2000s, and we've got a bit of a history now of using the data to be able to really work on what's going on. John, I appreciate that. Thank you very much, and glad to be providing some stimulating content to you. Now, we can slice and dice the data, and we've got this sort of Rubik's Cube idea, which basically means that we can manipulate it as we want to be able to slice and dice it and look at different dimensions. Quite important because, of course, different people want different perspectives. We can segment by property status, geography, our master segmentation, and other things, and all of those are available in the sort of situation as we go. I'm going to try this. This is a new overlay I've developed, so I don't know whether this makes it easier or less easy, but I thought I'd give it a go. Just in terms of the Rba Minutes now, this is the first slide. Very interesting. There were some changes in the minutes that came out today. And the first thing is the Reserve Bank has really focused now on the international developments and the risks that are rising and growing. And I think that's quite fascinating insofar that previously they'd always argued that it's really about wages growth and employment, and provided wages growth and employment runs, then essentially everything's going to be fine. But what they've really now said is that the uncertainty around trade policy and other things, the activities of central banks around the world, all having an impact. Glenys, thank you very much. Really appreciate your contribution, and glad that you love the channel. It's good to know. And yeah, Jill really appreciates those comments too. The other thing they've said is that there's a lot of uncertainty about consumption and a lot of risks, but they did actually specifically say, but the housing market is looking a little more positive, and therefore, because the housing market is looking a little more positive, things may be a little bit better. And I think that's quite interesting, and it goes back to this theory that we've had for some time, that the government and the Treasury here in Australia are essentially using the housing market as the engine to try and restart growth and momentum in the economy. The question is, of course, is that likely to be successful? And I think it's also worth just highlighting that the market is pricing in another 2 rate cuts, and I suspect we're going to see one in October and probably one in February. So that will take the cash rate to well below 0.5%, and that may not even be the end of the story. But the thing I want to make clear here is that the Reserve Bank is beginning to build an argument to say that it's the international situation which is creating the problems locally. And interestingly, you can argue whether it's true or whether it's not true that it's the international crisis that is creating it. I think it's plausible demandability. I think it's poor RBA policy. Now, I've got a very important task for Genevieve. Hi, Genevieve. And just want to say to Veronica and Louis today, and I think it's probably time to bed. Thanks. I hope that's good, Genevieve. So, yeah, the key point there is that the Reserve Bank is, I think, beginning to build an excuse. And that excuse is that there's an international problem, and that's created the local problem. No, it's not right. They've had bad policy for probably 8 to 10 years, and I think that's probably what they're trying to avoid talking about. Now, just in terms of a couple of other charts, think about this in terms of the economic drivers of Australia. So firstly, business confidence is dropping, and that came through in the NAB Business Confidence Survey and also in the Australian PSI. In both cases, the metrics are showing a decrease in momentum activity, and a lot of that centered on retail and construction. And so businesses are not that keen to invest, in my view. In terms of households, and we've reported the Household Confidence Index and also our mortgage stress data, 32% of households in mortgage stress well than 1 million. And Raj, thank you very much, appreciate that. And also the Roy Morgan ANZ Weekly Confidence Survey came out today. That's the one down at the bottom on the screen there. And interestingly, that is also showing a drop. So we definitely see the situation where we are watching households' confidence decay, drop, and become less and less likely to support the economy. They've got less ability to spend, of course, because incomes are flat, cost of living are rising. And I think this is going to put a bit of a dampener on the housing market ahead, as we'll talk about later. Third one is trade. So there's a very interesting story here. We had a record trade balance of $8 billion in June. That was driven significantly by export earnings, and a lot of that came from the metals exports, obviously to China and elsewhere. But the other way to think about it is imports were pretty flat. You can see that here in the chart. Imports are pretty flat. So in fact, that is a sign of less business activity. And that goes back to the fundamental issue we've actually got. It's pretty significant, of course, because essentially with the resource sector potentially looking a bit wobbly ahead, our trade momentum could certainly reverse quite quickly. And the exchange rate doesn't help particularly. Hi, Tina. Thank you. Really appreciate your contribution. Thank you so much for helping us out. And here's a really important chart. The iron ore price is now down at 92. And of course, it's been up at 120. And the key thing about that is, of course, is that if the iron ore price drops, then effectively the the exports that we actually make and the money we import drops. And BHP, of course, announced a very significant profit today, and that was really on the back of very high prices. The other thing to say is that there is some evidence that China is slowing imports of some resources, taking longer to process them and trade and allow the trade to come through. And there's also more international pressures now in terms of other areas where, for example, in Brazil and elsewhere, where now other people are starting to export iron ore. So the thing to watch here is essentially what happens ahead, because if that trade begins to decline, if the iron ore price continues to drop, that's going to have a big impact on the balance of payments and on GDP. And the final point is that, of course, the Aussie dollar is now at 67.77. It's probably moved around a bit since then. I did this chart earlier in the day, but you can see the slide down over recent times. My expectation is the dollar will drive further south. That will have an impact in terms of importing inflation, which may or may not be good depending on how you look at it. But nevertheless, the fact of the matter is that the exchange rate is giving a signal of potential weakness ahead, in my view. And just the fourth economic driver, of course, is government spending. Now, the tax take has been pretty strong, and that's a combination of taxes from businesses as well as individuals. And we have bracket creep, of course, all of those things. But the critical point I want to make about government spending is that it is all about the amount of investment that's being made. And, of course, the fact of the matter is that the government is holding to its view of wanting to not run a deficit on an ongoing basis. So the precious surplus means that their ability to invest is actually quite limited. And that is creating an interesting tension with the Reserve Bank, who, of course, has been saying there's a limit to what the monetary policy can do, and the government needs to do more in fiscal and effectively more infrastructure spending. The problem about infrastructure spending is it takes a long time to set up and run, and it doesn't really generate significant momentum immediately. And I'm afraid to say that I think the economy is continuing to show very strong signs of weakness, and essentially it's time to perhaps act quicker. But, you know, you remember what Rudd did a few years ago, basically, you know, go slow, go quick, I should say, go household. Well, I think there's a beginning to build a case for some of that now. And frankly, the tax cuts and the interest rate cuts of recent times really aren't touching the sides in terms of changing the trajectory. And it's worth saying that house lending is still weak. This is housing finance approvals by segment from Westpac. And you can see there, astonishingly, 83% drop in terms of foreign buyers, 83% down from peak. The first-time buyers are down. The investors are way down, 48% down from peak. And upgraders down 21%, just a slight uptick now, but still well down. So the fact of the matter is, with all of the momentum that people are talking about in the housing market, that isn't translating to lending yet. However, I must say that some of the leading indicators I'm seeing from some of the banks and from some of the people I talk to in the industry suggest we may well be seeing that beginning to move up. And so then the question becomes how much lending will be increased, and how much of that is refinancing of existing loans versus new business. And Paul, thank you very much. I really appreciate your contribution there. That will help us to make more great content. So thank you once again. Now, with regard to home prices, it's worth just pausing to see how things have dropped. This is from the CoreLogic data series. And the fact of the matter is that the drops have been quite substantial and over quite a long period of time, particularly, of course, in Perth and Darwin. So we've got a long way to recover to where we were. And, all of this conversation about the change of trajectory in home prices and everything else has to be set in the context of these significant falls. And as I keep saying, the problem we've got is that these averages. And of course, we know that in some parts of particular postcodes and for some types of property, and I'm thinking here particularly of units, particularly high-rise units, they're down 30, 35, 40% now in some cases. So there are probably some offsetting movements, but nevertheless, the fact of the matter is prices still look quite wobbly. AS, thank you very much. I appreciate your contribution. That really is very great help to keep us on air, as it were. So I guess the question then is this movement in property prices a sign of life or a bull trap? And this is the CoreLogic annual chart that I showed the other day. And it just shows that there's been a bit of an uptick now in Sydney, Melbourne. Very significant uptick, actually, quite sudden uptick. And no one's explained to me why that has suddenly happened, because we had a long period where prices were basically going sideways, having effectively moved up very slightly earlier in the year. So there's something funny about that data, which we haven't really had an explanation for as yet. And of course, if you analyse that significant uptick, then it would be remarkable growth, but I don't think that's real. So you have to say Adelaide is still sliding, although there's just a slight movement up last time. Perth, of course, is still moving sideways, and the 5 cities average moved up a little. Just to explain, these are the ones that CoreLogic publish in their index every time, so they don't publish the same amount of detail for places like Hobart and some of the other smaller locations and states. So unfortunately, I can't provide the same level of insight as I do with these ones from CoreLogic each week. Now, just in terms of the international context, one of the things I think it's quite important to understand is that essentially there's a feedback loop in play, which means that the Fed tends to ease in response to, for example, Trump imposing more tariffs on China. As a result of those tariffs being imposed, the economy then essentially weakens. So the Fed eases. That puts a little bit more momentum back in the economy. The market strengthens, and then more tariffs. And that doom loop is what's been going on for the last year or so. And now, of course, we know that China has actually reacted, and of course they've been moving their exchange rate, or indeed perhaps doing less manipulation in the marketplace than previously. And now there's 7 US dollar to the Chinese yuan. And of Trump, of course, accused them of currency manipulation. I'm not sure that is really the true story, but clearly there's something dynamic going on here. But the point I want to make is that generally around the world, what's happening is that the politicians are stepping back and leaving all the heavy lifting to the central banks. The central banks are locked into monetary policy of a relatively classic nature, including quantitative easing and those other things that we've seen, and basically keep yelling over the fence to the politicians, say do more, do more, do more. But at the moment, the politicians are choosing to do less, do less, do less. And that's part of the problem. And then, of course, you have people like Trump, who basically then jawbone the Fed. He said he thinks that the Fed should be cutting rates hard, for example. Interesting that that interaction is part of the picture too. So there's a lot going on with regards to all of this momentum. But, my takeout is that we have to take due notice of what's happening internationally. And I've taken that on board as I thought about my scenarios. So the other point there is that we know rates are going lower, and we've already featured this, but just to re-emphasise, Denmark, for example, has a negative mortgage, a minus 0.5 a 30-year mortgage. That's because they can get very cheap money, and they want to lock people in so that they are continuing to repay those mortgages over time. And those capital flows, those capital repayments, essentially help to manage the cash flows of the banks. A lot of the bonds, of course, have now gone negative, and we're seeing more and more of that. And what that essentially means is that people are not actually making any money. They buy at one rate, they sell at another rate rate later, and they lose money in the process effectively, or to be more precise, they don't make anything. And it's remarkable, if you think about it, that investors are happy to hold capital and not actually make any return. That's a sign of ultra low interest rates and all the issues that we've been touching on. Nigel, appreciate your contribution. Thank you so much. Thank you so much indeed. Now, just in terms of our core market model again, the scenarios come off our modelling. And so I just want briefly now to go over the scenarios and update them for you. And then we'll take some questions. Okay, 4 scenarios. The scenarios, well, slightly more than 4, but our scenarios are ways of trying to think about what's going on and trying to sort of portray some of the different dynamics. And the reason we use scenarios is that there's no right answer to this. This is my opinion. It's based on all the models. It's based on plugging as much information as I can. I've got some different scenarios, some different outcomes, and we can talk about them. So here are the scenarios. We have a business as usual one, which basically is, let's assume the RBA trajectory is right. What happens? One we call things going to get better, which is effectively a slightly worse scenario in terms of momentum. Not yet doomsday, which is another scenario. Both those 3 are essentially focusing predominantly on what's happening locally. And then we look at what happens if we get an international crisis coming over the top with Armageddon, which is I call Ireland 2.0, or Doomsday, which is Iceland 2.0. And I'll explain a bit more of those as we go through. So those are the scenarios we actually run, and then we look at them from what the Reserve Bank rate, cash rate might be, unemployment rate, mortgage stress levels, bank losses, home prices, unnatural acts, in other words, some of the things that might be being done, and my probability rating based on the models. And I should say this 24 to 36 months is essentially based on where I started modelling this, which was last year. So it's about nearly a year in now. So essentially over the next 2 years or so, this is how it could play out from a time frame perspective. So we'll just look at the first one. So you can see there that I've highlighted in yellow the changes. I'm just going back to the big screen on this one because there's, let's go there. Yep, that should make it a bit easier to watch. So you can see there that the Reserve Bank rate, I think, will be at 0.5%. That's pretty much what they've said. That's pretty much what they've signalled now. I think the unemployment rate won't be at 4.5%, which is what they're aspiring. Their latest statement on monetary policy was talking about 5% in a couple of years' time, which is actually very bad news for the Reserve Bank because they were saying if they could get employment down to 4.5%, then potentially they could see wages begin to lift. So there is no prospect, in my view, of wages moving up anytime soon. Mortgage stress, around 32% of households. That's roughly where we are now. That's because as mortgage rates go lower, because the Reserve Bank cuts the cash rate, some households will be able to actually step back from being in mortgage stress. The bank losses will be about 3 basis points, a little bit higher than currently, which is sitting around 2 basis points or so. And I think that house prices on average across the country will be up 5 to 8% over that period. In some places they could be a little higher. In some cases they could be a little lower. And we will see easing credit rules, probably more of the things we've seen already. We'll see quantitative easing. We'll see obviously very low interest rates. But the point I want to make is that last time I gave this sort of RBA scenario a weighting of 15%. I had to drop it this time because I think it's extremely unlikely that they are going to be able to even achieve that sort of baseline view. And if I am correct on that, then essentially the economy is going to be performing much worse than the Reserve Bank still wants to accept or admit, despite the fact that if you compare what they're saying now with even 3 months ago, they've ratcheted down their prospects quite strongly. Now, in terms of my next scenario, this is the things going to get better. So rates still at 0.5%, but unemployment now higher, and that's particularly driven by falls in construction. We think there's going to be about 250,000 construction workers without jobs within this time frame because the high-rise sector is going to really collapse. We've already seen it, partly because of lack of demand and partly because of the poor quality construction that's been featured. ABC featured it again last night. We've been talking about this for a year plus already. Mortgage stress will be a lot higher. The reason for that is that as unemployment rises, people's ability to manage their mortgages gets more difficult. 36%, if that were to happen, would be the highest ever. And that's then leading to high levels of default. So the bank losses are up at 5 basis points rather than 3 basis points. And home prices now not up but down over this time. So in this model, it goes up. They go up a little. They go up into the spring, effectively start falling again after sort of March, April time next year, and then fall further. And we'll see easing credit rules. We'll see fiscal stimulus, a whole bunch of additional activities from the Treasury as well as from the Reserve Bank to try and stoke the bubble a bit more. They will be unsuccessful. And I've increased, JB, thank you so much. I really appreciate your contribution. I've put this up to 30% from 25% because I think that this is a very likely scenario now. If we don't get a big international crisis, I think this scenario is the most likely of the local homegrown ones. But of course, that isn't the end of the story. We can also look at the not yet doomsday. So this is effectively now where we see, again, the cash rate very low, but the employment rate goes higher. Now, this is where businesses really start ratcheting back employment. The partly employed and underemployed rises considerably. From Piston there, thank you very much. I'll talk about negative interest cash rates just shortly and how that may pay out. It's one of the questions which I'll come to, so I'll come back to your question, but I appreciate your contribution. Thank you. Unemployment rate 6.8%, mortgage stress levels again 36, so that's very high, but the bank loss is now considerably higher. Home prices 20 to 30% down. One bank in that situation will struggle, will need to be bailed out in some way, or bailed in, or some other way, and that's still got a 20% rating, so that hasn't changed from last month. Then we go to our Armageddon scenario. Now this is where effectively the international crisis comes through, and it could be triggered by the US going into recession. The probability is growing there. 70% of economists in the US now thinking there'll be a recession in the US within the next 2 years. It could be caused by China. It could be caused by Brexit. I'm very concerned now about what's happening in Brexit. I think that the stupidity that's playing out there could actually create a significant issue. We know that Europe is already under significant pressure, and we know that many of the German economy, for example, other European economies are really struggling. They are talking about doing more quantitative easing there already. The question is there any reason to think that more quantitative easing will lead to anything other than just low interest rates? And I can't see that it will. Now, if that were to play out, we could see, in a worst-case scenario, then unemployment up at 8.75 to 10%, that sort of range, a very significant hike, a very significant rise. Mortgage stress, of course, will go through the roof at that point. Many households would just not be able to repay those mortgages. Many people would default. The banks probably wouldn't be able to foreclose because there'll be no one wanting to buy the properties, so people will be living in those properties. This is exactly like what happened in Ireland, and even 10 years later, Ireland property prices haven't really recovered in some places. There are people still with massive debts that they're still trying to get out of, a lot of negative equity. The bank loss is a lot higher, 12 basis points plus. Home prices down 30 to 45%. There should be a negative there, I've just noticed. So don't think I'm forecasting a rise of 30 to 45%. No, it's a fall. So a significant fall. And the reason I say that is that against fair value of property, we're still on average in Australia, even now, 40% above where we should be. And that's because the market has been stoked by lending that's been off the scale for a long time. And if you come back to what I think is a fair and reasonable ratio of income to costs and those sorts of things, income to GDP, prices would need to be 40% lower, which is where my 40% worst case scenario comes from. There'll be bail-in, there'll be bail-out, there'll be QE2, in other words, more than just purchasing government bonds. There'll be a whole bunch of other things, and we may even get some helicopter money in there as well to try and stimulate it. Now, this has gone up this time. Last time it was 25%. This is now 35%. So I see this now as a very strong probability. If the international situation continues to deteriorate, and I think a lot of it's to do with trade and what's happening there, plus the other things that we've discussed. And then the last one, just to round out the picture, is if in fact the banks weren't bailed out, if in fact there was a willingness to let the banks crash, we would actually see then a doomsday scenario, and therefore rates would be lower, 0 or below, unemployment rate would be way, way high, very high levels of mortgage stress and bank losses. and home prices would drop significantly. And the reason for that is that essentially this would be a reset. This would be a significant and massive reset where effectively home price values and loans would all be reset. Now, I give this a very low probability. The reason I give it such a low probability, and I've taken it down, is that I don't think there is any evidence of any central banks around the world willing to countenance this particular view. Iceland was a bit of a unique scenario. A decade ago, they actually declared UDI and said, right, no, we're going to let the banks crash and sweep up the mess afterwards. And in fact, they've done quite a lot better than many other countries by going through that deep recession, that deep reset. And we did a post on this last week, last year, John Adams and I may put a link in the comments below to this particular post where we spoke about the difference between Ireland and Iceland. And there is an argument to say that if you continue the Ireland 2.0 approach, essentially the fact of the matter is that it just continues and perpetuates the same processes, whereas in fact the doomsday scenario is a way of a resetting, but frankly there's very little appetite politically and economically for that at the moment, despite the fact that in some ways that might be the best answer. Okay, so those are the scenarios, and just to sort of give you a bit of a flavour finally as we come to the last slide here. So the first half of the chart is basically muddling along on our own. Where might we be? I give a 10% chance to the Reserve Bank for being right, even there with their revised, less bullish scenarios than they were running previously. I think the greatest probability is ultimately coming from an international crisis coming in over the top. But I think there's also a reasonable chance, if you look at that 30, 50, somewhere around here is still where we are. So from last time around, essentially I have downgraded the Reserve Bank's probability of succeeding. I've increased the probability of an international crisis, and I've detuned the focus on the doomsday because I can't see any evidence anywhere of what may be happening. And again, just to re-emphasize, that's minus 30 to 45%. I forgot to include the minus in when I updated the charts, unfortunately. But think about the implications of that. If prices did drop 30 to 45%, many people would be in negative equity. Then mortgages will be worth a lot more than the properties, and that would be a big deal. Okay, so I hope that's been of some use in terms of just setting the context. So I'm going to come back now to the chat, and I'll start picking up some of the conversations and some of the questions. It's great, Harmony, thank you very much for saying you've been watching from the very start. Yeah, what I think is quite amazing is the number of people who've been following DFA right from when we had just a few tens of followers. And the fact of the matter is that the story here is a long, slow grind, right? And what we've been trying to do is to tell the story as it evolves. Now, somebody's asked, is my doomsday scenario similar to John? It's not precisely the same. John actually has a whole different range of scenarios that he explores, including hyperinflation and deflation, all those things. So I haven't necessarily directly overlaid the same thinking as John, but I'm coming to some similar conclusions in terms of some of the things that I'm likely to see. Wayne, thank you very much. Appreciate your contribution. Okay, now Bella's is asking about bail-in. Yep, I thought I might get a question about bail-in. So there's a lot to say about bail-in. And the thing I first want to say is that in Australia, the whole situation is extremely unclear. There was a law passed through the back door, effectively, by Parliament, that opened the door for bail-in, but it's not clear. It's not like New Zealand, where it's absolutely clear their deposits can be used in the case of a bank getting into difficulty before it fails. They can grab deposits and other assets and essentially restructure the bank, so you change your deposits to become a shareholder in the bank. In Australia, it is extremely unclear as to whether that does or doesn't exist, because one, the law is very unclear. Two, everybody in political circles, APRA says, no, we're never going to bail in. Except three, we know internationally that the bail-in regime was brought in through the G20, and around the world, many different countries have started to bring in the bail-in regime. IMF is imposing it and recommending it and basically saying to Australia, come on guys, get seriously. So there is a chance in a crisis that deposits amongst other assets could be grabbed, could be converted into equity in a failing bank. Now, by doing that, the bank then doesn't fail, and that means that the deposit guarantee doesn't ever get action. So there's a 250k deposit guarantee, which in theory is available if activated by the government on a bank-by-bank basis. But if the bank is bailed in and it doesn't fail, that deposit guarantee potentially may never be activated. Now, in some cases in Europe where there's been bail-in, they've actually bailed in above the guarantee amount. In others, they haven't. It's very unclear as to how this would play out in practice. Now, with offset accounts, the question then is, if I've got money sitting in an offset account and I've got a mortgage, does the bank have the right of offset one to the other before anything else? I think the answer is, yes, but it's not clear. There's nothing definitive actually documented anywhere. And all of the documentation, if you read your mortgage documentation closely, and I do recommend you do that, the small print basically says they've got a lot of different latitudes as to how they deal with those situations. But my own view is that the offset account would be set against the mortgage first rather than actually bailed in, but could be wrong. It's also worth highlighting that these are individuals. Deposits doesn't necessarily mean the same for corporates. So there are particular categories of deposits that potentially might be bailed in. The thing I want to say, though, is we have to push the government for clarity on this and on APRA on this, because they are deliberately obfuscating. And in a crisis, my view is it's very likely that they would actually potentially have to go down this route, because the alternative, of course, if they don't bail in deposits, is to bail out the banks. And of course, you go back a decade, that's precisely what happened with the global financial crisis. Banks around the world were bailed out. Massive amounts of taxpayers' money were actually used. And what have we got to show for it? Well, not sure, actually. To be frank, we didn't really learn the lessons from a decade ago. So bail-in is definitely something there to be thought about. But I do say it's not clear. It's very fuzzy. And I think it's deliberately fuzzy in Australia. And one of the things you might want to do is to go and sign the CEC's bail-in petition, which is basically asking for clarity and certainty around the bail-in. And I think it's a really good initiative. Okay, so I hope that's answered that one. So going back specifically to offsets, I suspect primary offset will be, the positive versus the negative, as it were, net position beyond that. By the way, think about this. If you have superannuation in a self-managed super fund, you'll probably get that, caught up. If it's within a superannuation entity, then essentially the structure will be very different as a result of that. The bail-in and the bail-out sort of and the deposit guarantee thing will be all very different. So it depends on the different classes of deposits. Okay, so Chris says, if bail-in is not clear in Australia, then how can it be clearly enforced if such a situation would arise? Good question. So, read the changes that have been made recently to so many deposit accounts. Read them. Across the board, many different banks now have got clauses which basically said, if the government said do something, we'll do something without notice, right? That is essentially giving an open door to, if the government decides via APRA, or if APRA recommends bail-in, there is an open door now in the terms and conditions that allows bail-in to happen. Wasn't there previously. In theory, the logic goes like this. For stuff to be bailed in, it needs to be in the terms and conditions of the particular products and services. And there are examples of, for example, convertible bonds, which are clearly bailable in. So there's no argument about that. And it says it in the terms and conditions. But when it comes to deposits, it's feasible for a bank to change the terms and conditions because the government has asked them to, immediately without notice, and then potentially open the door for bail-in, potentially. That's the way I read it. Could be wrong, but that's the way that I've thought about it, and we've got legal opinion to that effect as well. So it is extremely unclear and extremely complex, but I think it's deliberately obfuscated. Peter's asking about the old yield curve. Yeah. So the Australian yield curve is obviously inverted now. In other words, the long-term rates are very much lower compared with short-term rates. And the yield curve is an interesting animal because it has traditionally been used as a significant indicator of trouble ahead. So the Fed did some research some time ago and showed that in the yield curve inversion, in other words, where the long-term rates were lower than short-term rates, was almost always a precursor to a recession of some sort. And the question is, with interest rates as low as they now are and with the massive amounts of quantitative easing, has that link been broken? And there are some economists who are arguing that all this fuss about yield curve inversion, and those rates are very low long term, are missing the point because effectively there are structural differences now because of QE and those other things that are going on. There are a lot of other economists, and about 70% of them in the US, who think that there's a very strong correlation between negative yield curves and the prospect of a recession later. And they point to things like the Trump stimulus packages, tax cuts, having a positive momentum in the short term, but then draining away. The fact that many corporates in the US have borrowed, quite big actually, at very low rates, to effectively buy back shares, which gave the stock market a bit of a spike. But many of those companies are zombie companies. They're actually not generating real profits. And without the share buybacks, shareholders would not be getting anything like the return they should. They've got big debt. Obviously, the total debt in the system is rising, as you will often hear from John and myself. We have the biggest debt bubble around the world and the biggest debt bubble here in Australia. So the other thing, of course, which is that we're thinking about is that yield curves are an implied view going forward. They're not accurate. They're only a prediction. They're only a suggestion, and other things can change. So yield curves do move. If yield curves go flat from short to long, that's a sign of uncertainty. If their rates are lower longer term, and people basically are saying, I'm happy to tie up my funds for a long period of time at almost nothing, because at least I've got those funds. So it's a sign of the uncertainty that's in the system at the moment. And of course, that yield curve also drives bank funding costs, and it drives a whole bunch of other things. It even links to the exchange rate. Okay, gold. Yes, I knew we were going to talk about gold. And Brian's asking about which is the bank that I think might collapse. I'm not going to tell you because I don't think it's fair on them, and I could be wrong. What I can say is that those with greater mortgage exposures, particularly those who are actually reporting maybe high levels of default, could well be wrestling with some of those issues. Now, with regard to gold, there's an interesting question here, right? The formal logic goes like this. Gold is a good hedge because gold is worth something, and we always know that it's worth something, and it's, gold is gold is gold, so as long as I hold gold, I've always got some value. Sort of right, except my question is, the question is, when you want to convert gold into something useful, how do you do that, right? You have to go through some sort of exchange rate, some relationship between gold and something else. What is driving that relationship? Well, it's basically the financial markets, it's supply and demand, all of those things. Now, those prices are somewhat artificial because there are lots of different dynamics going on, right? So, yes, gold is gold, and you could say that I've got it and I'm holding it and I've got to store it somewhere, but, I've got it. But it's when you come to make use of it. And okay, you could probably use it to buy things directly, I suppose, in a major crisis, although it might be a bit difficult to go down to Coles and pay with a gold bar or a piece of a gold bar. I could see that could be a problem. So the theory is that gold is meant to hold its value and it's meant to be a stable base, right? And there are many people who are buying gold or indeed silver, which is perhaps less controlled. Worth reflecting, of course, on the fact that there is a law in Australia that potentially allows gold to be grabbed in certain circumstances, if by the government. Not sure they would, but they might. And my point is, I don't know what the value of gold is. I know that it's highly manipulated. I know there's a lot of people buying it around the world. And a lot of Eastern European countries and China and Asian countries have been buying gold because I think the long-term play is that the US dollar will at some stage cease to be the cornerstone currency that it is. at that stage, it may well be that gold then takes a more important role in terms of buttressing other currencies. Hard to see, hard to know. So, there are many people who think that gold is actually great value, and that's why the price of gold is going up. It's limited supply, all those things. But there are a bunch of questions which I don't think are satisfactorily answered by many of the gold bugs that are out there. And I will just touch on, digital gold, Bitcoin, because many people will say, well, Bitcoin's easier because, you don't have some of the limitations of gold. And I did a post at the weekend which highlighted the fact there's been a bifurcation between the price of gold and the price of Bitcoin. And as I made the point, it could indicate potentially an opportunity, or it could show that maybe there's a diversity really going on now. I'm quite skeptical of Bitcoin and how it might play out. It might be good, might be not. It's highly speculative. So neither gold nor Bitcoin, in my mind, is a watertight solution to dealing with the financial uncertainty that we have. And that takes me to a broader issue, and it's another question which I've had from a number of people is, well, in this current uncertain time, with deposits going to zero and, everything turning a bit sour, where should we put our savings? And I can't give you specific advice. What I would say is it's really tough. It really is tough. There will be many people who will say, I still want to hold money in the banks because that's 250k deposit. If I spread it across multiple banks, particularly smaller banks, then that's a reasonable buttress, but you won't get much for it. The term deposit rates continue to fall, and my expectation is that term rates will continue to drop lower and lower and lower. Many people are relying on that income just to get by, and many people, 3 million of them, are reliant on income from term deposits and the like. That means they're going to spend less at the shops. Other people will say, well, maybe I should buy property. And, maybe now is a good time to buy property because effectively prices have come back 15, 20% maybe in places. And maybe prices will go up. Maybe there's going to be more demand. Maybe. But as I've shown you in my scenarios, property prices could go up, could go down, could go sideways. There is a lot of uncertainty around property prices. And my own view has been for some time that I think there's a chance of a bit of a bull trap. In other words, property prices start rising, people buy into that, thinking they're going to accelerate away, and then they turn and drop again. And some of the modelling that I'm doing at the moment suggests that we are looking at potentially a bull trap for about 6 months. It could rise. Next year it could drop again. And as I said earlier on, if the scenarios from an international crisis are actually playing out, that's where that actually comes into fruition. So property is tough. Shares are pretty tough. Bonds, well, yeah, you could do bonds, I suppose. Just bear in mind that, the thing about bonds is you have to buy now, you get a certain amount back at the end. But the pricing of bonds is such that in some cases the bond yields are close to zero. So it may be good. If in fact you want to try and safeguard capital, there are some risks and issues around bonds, of course, which people may be aware of. What I'm trying to say is there is no simple, straightforward answer about trying to safeguard financial security at the moment. We are in a very, very insecure environment. My own strategy has been to spread the risks and to essentially try and keep agile. I went to cash some time ago because I think that actually cash, despite low returns, is probably a good place to be at the moment. One of the reasons why I think the cash ban is so insidious, because I think there's a plot behind it, as we discussed previously. Okay. Adam asks about Rba. Yeah, I do sometimes follow some of his stuff and listen to what he has to say. I think he's got some interesting perspectives, and many of them resonate with what I've been saying. Some are slightly different, I think. I have to say that because of the fact I spend all of my time making content and doing analysis and reading reports, I don't spend a lot of time watching other YouTube channels. And if I had more time, I probably would. But things are a bit complicated at the moment with everything that's going on. So I tend to focus more on the information and trying to get the models to work and those things. But there are a number of people who I think are actually making interesting positions. You may have seen the post from Zhang that we did a little while ago from ITM. You might or might not think that she's onto a good platform there, but I think some of the points that she made is very interesting. I think there are other people with alternative views and other perspectives. What I'd say to anybody who's trying to actually decode what's going on is read wide, get multiple points of view, don't swallow any particular line, hook, line and sinker. Be a bit critical of all of them, because actually everybody will have a particular perspective, a particular worldview. I have a particular worldview. My particular worldview is it's very complicated and difficult to read a way through this. It's very hard to secure savings. It's very hard to know where property values are likely to go, which is why I'm a bit bearish about how things are at the moment. But other people may have a stronger point of view, and frankly, goes back to what you think of the scenario. If you think the scenario is going to be scenario one, the RBA is going to be fine, then you might go down one track. If you think that doomsday is coming, then you will go down a different track. So perhaps my advice is start with thinking about how the scenarios may play out, then think about what levers you could pull in those situations. What I would say is it's often useful to diversify, it's often useful to be flexible, and take account of new information as it comes in, and we keep updating as things happen, of course. Okay, what else is going on here? Okay, I'm just reading some more. Okay. Now, let me go further on negative interest rates. This is a question I've had a lot of people ask me about. Is negative interest rates new and different, or is it essentially just more of the same, right? That's the key question. And I have to say that I find the whole concept of negative interest rates insidious. There are people who are simply saying, well, zero is just a level, you can drop it down and the same processes work. I don't believe that. I think there is something fundamentally different about the fact that you have to pay to keep deposits. And I did a post on this the other day to say, the concept would be, we're storing your money for you, but you need to pay us to allow us to store your money with us, which is remarkable and quite different from where we've been. Adam, thank you very much. Appreciate your support. Thank you for that. There are other people who are saying that negative interest rates is nothing really to worry about. It just means that loans were very, very cheap. By the way, it's unlikely that many mortgages will be negative. Most mortgages will be a very low interest rate because the banks will still need to make a margin. And it's very important to understand that even with those low rates, guess what they do? They add lots and lots of fees. So if you look at the Scandinavian mortgages that are actually paying a negative interest rate, the banks are taking big fees to still make a margin out of it. They're just making it a different way. So you need to look at the total holistic view of the mortgage, not just the interest rate. The problem that I've got is that, and the IMF made this point in one of their papers that we discussed quite recently with John, was that in a crisis, if you get an international crisis, you need to be able to cut by 4 or 5% to be able to actually give a significant kick to the economy to make it work. Now, rates are, of course, way low. Let's say around 1%, 1.5%. So there isn't the ability to give that kick unless you go strongly negative. The problem is that if you do that, then you're creating this whole new world where effectively suddenly there's no point in saving. Chances are people will actually pull money out of the banks and hold it in cash. Go right back to the cash ban, which I will come back to shortly because there's a few things I want to say about that as we go on through the show. But essentially what that means is that the whole concept of savings changes. It also may mean, because what they want you to do is they want you to spend, right? Basically, they want to make it to the point where there's no point at all in saving because borrowing is so cheap and they just want to spend, and they want you to spend and basically consume more. And if you consume more, the idea is that will then stoke the economy. If that stokes the economy, then the momentum will sort of turn over, and essentially that will create a bit more activity, which is what happened, of course, in the US over the last 4 or 5 years. But it's not solved anything, right? And what people will be doing is borrowing more and more and more. The debt bomb will get bigger and bigger and bigger. And so all it is doing is just sliding the problem down through the generation. And we could easily see, by the way, this gets to an intergenerational problem. We are almost there now, actually, in many ways. But what this means is that if we go into this negative sphere of interest rates, this is something which has never been tried. It's effectively an experiment. Europe has failed. I think Japan has failed. Scandinavia has failed in terms of making any real contribution to solving the fundamental issue. And so this is taking monetary policy to its ultimately stupid level. My own view is monetary policy is running out of steam. And as I said earlier on, that's because the politicians are stepping back and allowing central banks to try and actually play with monetary policy to save them having to do some of the hard decisions they should be doing. Now, of course, the alternative is things like MMT, where effectively what you're doing is creating a pool of funds. Governments can borrow very cheap, particularly currently. They could provide stimulus into the economy directly through, incomes or through direct infrastructure investment, those sorts of things. We'll be hearing more of that, I think, as we go. But ultimately, the problem I have is that the central bank speak and the central bank thinking is wired into this myopic view of lower, ever lower interest rates with no way out, no exit. And that is the problem I've got. I suspect that Jackson Hole, which is where all the central bankers are meeting, this week, I think, will be talking about taking rates even lower. But who is asking the question about why this is so dumb and what the alternative should be? I don't see enough of that in the conversation. So I'm afraid that I'm very worried about this whole negative interest rate environment. And, if you think about it, when I was a kid, I used to be taught to save. My dad used to make me save every week, right? And that's how I got into the discipline of saving and essentially was able to then ultimately buy a property and those sorts of things. If the value of money is so corrupted with negative rates, what we're doing is we're leading it to a generation who only knows credit. And the banks will love that because, of course, the more credit they give out, the more they make. But the question is, do we want to base our whole economy on just credit? I think that's a real big mistake, but it's ultimately where I think we could be heading. Okay, what else have we got? Gold and shekels, is it true they're removing physical land titles? Yeah, so what's happening at the moment is that the electronic registers are being implemented. So effectively all the land transfer processes will be electronified. There is also talk about privatization of some of those, which I think is a wrong move, but many people seem to be supporting it, celebrating it. It will potentially mean that land transfers can be done more quickly, but the digitalization of everything continues. And, the war on cash is another example of that, of course. And just to update you today, the ABC published an article on their news on the war on cash, and they featured the interview that John and I did with One Nation, amongst other things. Other articles have now been published. There is a change.org petition, which I'll put the details later. We've actually done a post tonight on the Interest of the People channel. Go and have a look at that later when I've finished here, if you want to. Change.org is running a petition there to basically show the level of objection. And interestingly, the ABC ran a poll, and last time I looked, 97.1% of all the people in the poll didn't want the cash ban to come in. The reason the cash ban is so critical is that it's required in a negative interest rate environment. People will take money out of the banking system and hold it out of the banking system and prefer not to put it through the banking system. As the IMF said, to make negative interest rate work, you need to be able to trap people within the banking system. And so this rule, this cash rule, is more about monetary policy and negative interest rates than about the black economy. And of course, we also know that all the research says that this is not a good way to even tackle the black economy. And of course, most of the black economy is in multinational land and the big accounting firm land. Nobody wants to touch that. That's where the big numbers are. So they're sort of tackling the bit on the side. And by the way, I also have heard, I think Labour will support the government in the bill. So we need to push very hard to get them to change their mind. Okay. What else have we got? Yes. Just reading a few of the... Just going back over some of the conversations. Okay, I'm going to talk a little bit about property. And a lot of people ask me, look, I've saved up. I've nearly got a deposit for a property. I'm seeing property prices beginning to move up now. Should I take the step now? And, is now a good time to buy is the sort of the question. And it's quite tricky. As I've said, my own view is that property prices will probably rise a little, but not a lot over the next few months. If you are looking at property as somewhere to live, shelter, all those things, and you are comfortable to potentially see the capital value move down as well as up, and you can afford the mortgage, and I always say to people, remember, rates are very low at the moment, but they may go up later, and you're comfortable about the cash flow that you've got and the job that you've got, all of those things, and that you've got the documentation to be able to prove to the bank a history of saving and a history of what your costs have been, all those sorts of things, then it's worth exploring. But do not buy high rise. Do not buy a new off the plan. There are so many reasons why you should not do that. Poor quality of construction. If you buy off the plan, you'll be paying above the odds. There are many people who've committed 18 months ago to buy off the plan, and then they come to actually compete and discover the value of the property's gone down, and the costs have escalated, and what they thought they had, they haven't got. So I would look at older property. I also happen to hold the view that property is a house compared with a unit tends to hold its value, although some of the inner city older style units are actually remarkably good value currently and potentially may hold their value well. So it depends where you buy and what you buy. And I interviewed Chris Bates, the mortgage broker and financial advisor, the other day, and go and look at his post. We talked about the fact that in some suburbs, in some locations, go for the really good ones. It's worth potentially exploring. But if you're going to the outer edge into those massive estates where there are lots and lots of properties the same, those prices are still falling. We know that prices around, for example, Liverpool and Campbelltown are down 20 to 25%. We know around Narre Warren down in Victoria, there are now price falls there. We know that around Brisbane, around Toowoomba, go further west, there are significant falls there. And we know that there are falls over in Perth. In Perth, there are prices down 30 to 35%. So it depends a little bit on where you might be going. Biber says, John Adams for PM. Thank you. Appreciate that. Yeah, he will, I think, will be significantly better at the job than current incumbent, I have to say. But yeah, so my theory then with buying a property is for your own use, yep, might be worth thinking about if you can tick all those boxes. Do your homework, look at property values in a particular area, and, do your due diligence. If you're looking at a newer property, even one that's 10 years old, it's important to understand whether there are any structural defects. And remember that although the ABC Four Corners focused on the high-rise, even low-rise properties can have similar faults and similar difficulties. There were many thrown up, poor quality construction, poor quality workmanship, poor materials, and many of those will not hold their value. And going back to the high-rise, I'm seeing now many high-rise in values in these apartments, if they can be sold at all, dropping 30 to 40%. People are losing $200,000 and are now being asked to pay $60,000 to $80,000 to fix up some of the issues they've got. The other thing with high-rise is you've also got all of the obligations with regard to the owners of the building and the community responsibilities for upkeep. Those are quite substantial. So my belief is it's the high-rise sector that's going to really lead the property market down ahead. And remember, there's 270,000 new high-rise developments still in train at the moment across the major centres. Okay, so could New South Wales plan infrastructure help to stave off? Yeah, I think it's a good point. There is no doubt that the big lever in terms of fixing some of the issues in the economy is infrastructure investment. The question is, will the states be able to afford it, bearing in mind that the stamp duty take that they've had for the last few years is dropping off a cliff? And I don't see very much turning it around anytime soon. And as a result of that, my own perspective is that, infrastructure of the right size and shape should be being done. I worry that some of the infrastructure projects that people are actually going with are pet projects or, something which is in a particular community because there's a particular local issue that people want to think about. I think it's really important that we get the right infrastructure investment. There's a crying need for better infrastructure in Australia. Partly of that, of course, is we've got very strong migration, despite what everybody has said in terms of migration easing, it's still very strong. I also think that we should think about the migration, turning the tap back a little bit, because I think migration is part of the issue here as well. Listen, thank you very much. I appreciate that. Thank you. Get a couple more shirts. Yeah, okay. I probably time, isn't it? I haven't got time to buy shirts. I'm too busy doing this stuff. So that's sort of my thoughts with regard to property. Now, investment property, be very, very careful. I know that there are a number of property investors who are looking to sell into the current slightly improved conditions. And that is because rental streams are continuing to ease. The value of property is going down. The switch from interest only to principal interest is continuing. And so the prospect of property investors, I think, is pretty limited ahead. You are not going to see anything like the rise that we had perhaps over the last 10 or 15 years. You are going to look at probably relatively stable at best to significantly worse conditions ahead. And if you're not getting capital gain in investment property, you are not going to make enough from the rental stream to cover the cost of the property as well as the interest on the mortgage, even at these low rates. Most people underestimate the cost of maintaining a property and managing a property, all those things. If you add all those things, more than 60% of property investment properties across Australia are negative at the moment. And that is a really big question. Okay. Now, Craig has asked about reverse mortgages. They're very rare at the moment. There was a bunch of rules that came in a few years ago which makes it very hard for banks to lend reverse mortgages. So basically you get a capital amount and then that amortizes the value of your property over time. But in most cases, you're not required to pay the mortgage back until you decide to leave it. It could be either because you've died or because you've gone into care. The question now is, with the values falling, with home prices falling and with values down where they were, it's hard to know what the residual value of that property should be and therefore what the equity might be that you can get. So that's one of the reasons why reverse mortgages are less easy to get. The second is there are a bunch of rules and regulations about the amount of advice that's given and the consents that need to be there in reverse mortgage. And the third is the deep discounts that people actually make, particularly now because of what's happening with property values, means that you don't get that much value out of the back. So I don't see that reverse mortgages are really going to take a very strong momentum. A lot of people, though, in retirement now have a mortgage. More people have a mortgage for longer. And that's a big deal because, of course, if you're reliant now on income from term deposits that we discussed earlier on, chances are you're going to find it very difficult to be able to actually get those income streams sufficient to repay the mortgage. And I worry about people who've got a property with a mortgage moving into retirement, because in the uncertainties of low interest rates and in the uncertainties of about property values, it is really very complex and difficult. I still believe that people should be thinking about essentially being mortgage-free by the time they move into retirement. That should be the aspiration, in my view. If you don't do that, then the chances are in retirement it's going to be a really difficult time. Okay, what else have we got? There's a lot of conversations there. We've got 870 concurrent viewers, by the way, so that's terrific. Some discussion there about Joe Wilkes in New Zealand. I don't think Joe has his own channel. He tends to work with me on New Zealand. There's more we want to do on New Zealand, and it's just a matter of time, I think. But there's a very interesting conversation to be had there, because in some ways New Zealand is somewhat similar, but there's also some unique situations in New Zealand, as we discussed the other day, as you may know. Yeah, James says when interest rates in USA go zero and the bond will turn negative, it's goodbye. Well, yes, it is. We're at that zero bounds level. We're at that, crossroads level where essentially it's essentially really difficult to know how this is going to play out. As I said earlier on, my view is that they've lost the plot. And I fear that the political pressures from Trump in the US to drive rates lower will ultimately mean that rates are lower. But I think recession is coming in the US. I just suspect that that is the way it's going to be. And if we get a recession in the US, it's going to flow around the globe. It will hit us quite badly. And that's one of the reasons why my scenarios are now stacked towards recession land. Okay, what else do we have? By renting for 3 years, buying a house on land. So yeah, it's an interesting question about, is it worth renting? Is it worth buying? Interesting question at the moment. Rentals are very low. You can get some amazing places to rent now that you couldn't get a few years ago. That may change down the track. But remember that we've still got a lot of empty properties. There's 1 million empty properties across Australia. And the old supply-demand lies are still being told by the property spookers. But we've got a lot of spare property around. And I can tell you something else. In many cases, I get news from renters that they're actually getting much better deals than they were. I'm seeing rental stress easing as a result of it. Ryan, thank you very much. Really appreciate it. And yeah, we do spend quite a lot of time on this stuff, but partly because we enjoy it, but also because it's really, really important. I think John Adams may be on. I'm not sure. I'm just trying to follow from the conversations. Okay. What is your best advice to a first home buyer? Wait or buy within the next year or two? Well, I've sort of tried to give you some views. If you're a first home buyer, why are you buying? Why do you want to buy? That's the question, right? If you are buying because you think there's going to be massive capital appreciation, forget it. If you're buying because you need somewhere to live and it makes sense to have, somewhere you can call your own, Kevin, thank you very much. Appreciate your support. It's worth doing, potentially. But you've got to do your maths carefully. Don't just accept what the banks tell you in terms of what you can afford. The banks are not assessing your ability to be able to actually make this commercially successful. They're only assessing their risk of loss. And essentially, you take the hit if capital values drop first. You lose your equity first. They don't, which is one of the reasons why they don't necessarily want to lend above 80, 85, 90% at the moment. Avoid lenders' mortgage insurance if you can at all costs, because that's a big cost. And I know some lenders' mortgage insurers are now making it monthly and those sorts of things, but it's still a significant cost. And the other thing to think about is if you do buy in now, you may have difficulty selling in the next 2 to 5 years, because I don't think we're going to see property markets bounce back anytime. So you want to try and buy somewhere where it makes sense for you to put roots down, not just some temporary property. And like I said earlier on, avoid high-rise, avoid units, particularly new ones, maybe older properties, maybe small houses. Other thing I'd say is that if you're a first-time buyer, consider carefully all of the costs of running a property. I don't know whether you've done any maths on it, but I'm horrified sometimes at the amount of cost just running a property: electricity, gas, water, repairs, rates, all those things. Often the costs are much higher than you think. There's some really good tools on the Asset Money Smart website that actually shows you how you budget. So do your budgets carefully, be conservative, borrow less than probably the bank is willing to give you, because that gives you some flexibility. And also, if you're a first-time buyer specifically, ask yourself what happens if you lose your job? What happens if your partner loses their job, for some reason? How would you cope? Really important to lay those plans before you commit. Fucking angry. Thank you very much. Appreciate your support. Thank you. All right, what's the time? 9:19. Goodness, I've been on a bit, haven't I? I get carried away talking about this stuff. I have not touched half of the questions that I had. I'm sorry. It looks to me as though I'm just going to run out of time again. Hopefully I've touched on a few different areas. I just want to sort of touch on one, and that is, few people asked about the economics of DFA. I will just talk about that briefly, because I had a few people saying, why are you doing this? What's the whole point of running the DFA channel? And I want to explain, we don't do it to make money. Every dollar we get goes back into effectively making more content. We do it because, one, we're passionate about informing the community about what's going on, and we think there's a job that's not being done by the mainstream media. Secondly, we are passionate about raising the level of financial education in Australia and New Zealand and elsewhere, because we're shocked at just how poorly educated people are when it comes to finance, and how they're just taken for a ride by the financial institutions who have a huge power disparity with consumers. The third thing is, we want to demystify a lot of this stuff, because a lot of the jargon means that it's way more complicated. It appears way more complicated than it really is. And if we can help to sort of paint a picture of that makes it more digestible and manageable, then I think we've succeeded. And the last point is, we know that there are a bunch of issues that are just not being spoken about, like the war on cash, like the building construction issues, which are now finally getting traction. We think there are some really critical issues that need to be shared. So those are some of the reasons why we are doing it. DFA will continue to do what we do, because I actually love doing it as well. I'm actually doing less consulting work than I did previously. And this takes me back to my personal circumstances. You may know Jill has been very ill. She was in hospital for 5 weeks. She's home now. She's still quite weak. So I'm spending a lot more time caring for her than previously. And I'm basically trying to prioritise what I do to those activities which I think add most value to the community, which is creating the content, creating the posts. I've not necessarily been able to answer the individual queries that I would love to be able to answer. I get quite a lot of them. I try to answer them. If you've sent me a question in the last couple of months and you haven't got a reply, one, I apologise, because I've just been way too busy doing other things, personal things as well. And two, if you still have an open question, send it to me again, and I'll have another go at trying to answer it. Adam, thank you so much. Appreciate your support. Thank you. Okay, now I'm just going to go back to the slideshow and just cover a couple more things I want to talk about tonight. And then we'll come back at one last set of questions. Just in terms of where you can get more information, so the DFA blog contains a whole lot of data. If you haven't subscribed to the DFA blog, you go across to the blog and do that, because you will get all of my reports, all of my alerts, and there's a lot more covered on the blog than I can cover on the DFA channel or IOTP. Choi, thank you so much. Really appreciate your support. Thank you. So go and have a look at the blog. You also can find our podcast there as well. We do podcast most of the material in audio format as well, because some people have asked for that. So feel free to use the podcasts. You can also support our work via Patreon. We've now got 245 patrons. That's up by 10 from this time last month. This is a really good way of, one, getting regular in terms of supporting what we do. And as I say, every dollar that comes through the Patreon channel goes back into the work we do. You also get some exclusive content and some early releases of data and information and other things. Pretty much all of the posts from IOTP and on DFA go up on Patreon as well, so that people can see them there. So please do consider Patreon. We are very grateful for the number of people who use that channel to help and support us. Or if you want to make a one-off donation, you can do that via PayPal. We get some people who do that, and they're greatly appreciated too. Very simple, very straightforward. And we even have a Bitcoin QR code for those people, because we kept being asked for give us a Bitcoin code. So there's a Bitcoin code, and we receive a small amount, not a lot, but a small amount via Bitcoin as well. So there are a few ways you can help support us. And like I say, all of that is simply going directly to supporting what we do and all the work we do. None of it is actually turned into profit. It's all about building more content. Now, just in terms of some top hits, I just need to focus in on the costs of the cash issue. So don't believe the establishments Cash Ban Lies and Propaganda, which was a John Adams and I post on IOTP. There's also on the DFA channel What I Said to Treasury, which was effectively my submission to Treasury about the cash ban. And the real issues behind the cash ban is also a DFA channel. That was the discussion with Robbie Barwick. That's our highest ever playing post, with more than 120 views now. And interestingly, more than half from overseas. The real interesting point there is a lot of people overseas are realising that we've actually put our finger on a very important issue, not just over here, but there. For example, in the US, they're talking about bringing in a faster payment system to centralise payments. Guess why? To digitalise it. Then there's Edwin's posts, Let the Games Begin. That was one we were talking specifically about the Olympic Park issues, but we actually have got several with Edwin. I'm recording another one tomorrow, specifically following on from the ABC Four Corners programme. Joe, of course, continues to contribute through his post. Shock and Awe was one of the ones we did recently, which got a good run. We've got a number of other participants too that we work with, and we'll continue to do that. And of course, I also put out the Property Imperative Weekly each Saturday, which is my attempt to try and boil back to about half an hour, plus or minus, all of the critical things that are going on, so that people can get a bit of a sense of, what is really going on. And I've tried to mix international and local news and try and contextualize it. Can't cover everything, but I must tell you that these are quite well received. Though interestingly, the Property Imperative doesn't get quite the plays that some of the more specific posts do, but I'm still going to do the Property Imperative. I still had grand plans to do more on capital markets training and other things, but because of my personal circumstances, some of that has to be put on the back burner. So I think that's pretty much all I want to cover tonight. I'm just going to go back to the main screen there and have one last look down. So I can see there's a lot of interesting debate about gold versus other forms of collateral. Michael's asked a question about new jobs. A lot of them are actually in the public sector. A lot of them are actually in the healthcare sector. A lot of them are in what I call the bedpan economy. And those, unfortunately, don't create real growth and momentum. We have a big structural issue in Australia insofar that, other than property and finance, there's very little value-creating activity. We dig resources up and chuck them overseas. We don't have a value-creating economy, and that's the real challenge that I think we face. I personally think that the real story here is that we need a completely different rethink about the way the economy works. We need to invest in real things, in the real economy, not just more expensive houses. That, of course, is a completely different agenda to the way the government is. And the other point to make, and it's one that a few people have been talking about on the chat, the financial system is very unstable at the moment. And it's unstable partly because of this zero bounds thing that we're talking about, but also because of derivatives. We've got a massive amount of derivatives around the world, bigger than ever. And, our banks here in Australia, most of them don't disclose how much derivatives they have. We know they're big. We know that the number's going up. And the thing about derivatives is nobody knows what the risks are in a crisis. And if you believe, as I do, that the international crisis is probably the one that's going to ultimately get us, then effectively the derivatives issues are critical. And because the derivatives are linked to banks who have deposits and loans, it means that effectively derivatives, if they go wrong, could create pressures on the rest of the bank, and that could lead to bail-in. So one of the issues is Glass-Steagall. I keep talking about it, the separation of sporty banking from meat and potato banking. We should have had it a long time ago. That would have solved the GFC if it had been there beforehand. And yet, of course, it was abolished. Clinton abolished it last in the US. There is a very strong case for separating the retail activities, the meat potato activities of banks, helping them to lend to consumers and to businesses from all this derivative stuff, which is effectively a huge risk in the economy. So effectively, my takeout at the moment, my summary, I guess, of where we are is we're on the edge of a precipice. We'll continue to report as we see things. We'll begin to share data, continue to share data. If there's good news, I will share that too. I'm not a gloom merchant. I just tell it as it is. But, I want to be honest with everybody about where we actually are. And, I think the next 6 months will be the test and the turning point. My own perspective has been for some time that it will be 2020 that will be the critical year when all of this stuff comes home to roost. So, as I sometimes say, batten down, buckle up. This is going to be an interesting ride. Wouldn't be surprised to see debt jubilees. Wouldn't be surprised to see quantitative easing and helicopter money being tried. But unless we can find a way to reset some of the political dynamic, some of the agenda, the central banks to think differently about it, then we're going to continue this circuit for a bit longer. And I suspect the next 2 to 5 years will be pretty uncomfortable. But there, again, at least if you've been watching DFA, you will be to an extent forearmed, and forearmed is forewarned. So, thank you very much for that. Really appreciate your time today, and we'll be doing this in a month's time, I guess, all being well. So, keep well. Thank you very much for your conversations tonight, and for all the conversations that you've had offline as well. Thank you for the contributions. Please continue to share, follow, and very importantly, please use your social media channels to continue to share this information more broadly. Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.